There's a reason institutional desks watch the open like hawks. The first 30 minutes of a session price in the overnight news, the gap and the bias of every algorithm, and the range they create becomes the day's roadmap. A clean break of that opening range is one of the highest probability entries you'll trade, intraday or swing. Today, how to define the range, the trigger that catches the real move, the filters that double your win rate, and the fake out trap that catches everyone else. Step 1. Define the range. Wait for the first 30 minutes of the regular session to finish, then mark 2 lines on your chart, the highest price hit during that window, the opening range high, and the lowest price, the opening range low. Some traders use the first 15, some the first 60. 30 is the sweet spot for most stocks. Those 2 lines are now the most important levels on your chart for the rest of the day. Every break, every fake, every move plays out against them. Here's the filter that separates the ORB that works from the one that gets chopped to pieces. Direction comes from the higher time frame, the daily chart. If the daily trend is up, you only take long breakouts of the opening range and ignore breakdowns. If the daily trend is down, the inverse. Without that filter, you're flipping a coin on every break. With it, you're trading with the wind at your back. The opening range tells you when. The daily tells you which way. Now the trigger. You don't enter on the first poke above the opening range high, wicks lie. You enter on the first hourly candle that closes above the range high, and ideally that close comes on a clear volume surge. The volume confirmation is everything. A break on quiet volume is a fake. A break on a visible volume spike is genuine demand. Stop goes at the opening range low. A return there means the breakout failed and the day's real direction is the other way. Target is a measured move equal to the range height projected from the break. Now the trap, and it's a brutal one because it happens fast. A candle pokes above the range, runs the stops of every breakout trader, and closes back inside the range on the same bar. That wick in reverse is the false break, and it traps everyone who entered on the spike instead of waiting for the close. The defense is mechanical. Never enter mid-candle. Wait for the close above the level, no exceptions. You'll miss a few real moves, but you'll dodge every fake, and the math heavily favors waiting. On a real chart, walk through the checklist before every ORB. Range mark, daily trend established, volume bar on the breakout candle bigger than recent average, close above the range high. If all 4 agree, you've got a high conviction setup with a stop you can define to the penny and a target you can math out. If anyone is missing, you pass. The opening range gives you a fresh setup every single session, so there's no reason to force a marginal one. So, mark the first 30 minutes high and low. Filter direction with the daily trend. Wait for the close outside the range on a volume surge, never on a wick. Stop at the opposite extreme, target a measured move. Done with that discipline, the opening range breakout is one of the cleanest, most repeatable entries in trading. Subscribe for the full method and trade your own plan. Education, not financial advice.